Hello, and thanks for watching our latest update. Reflecting on the current environment and the economic outlook, we describe it as constructive but complicated. A good example of that is the US. Over the June quarter, US equity markets again delivered solid gains, but investors sought relative safety, predominantly in the mega-cap giants like Amazon and Nvidia, and those companies that are seen as potential beneficiaries of the AI revolution. Now, if you remove those big companies from the picture, it all looks very different. In fact, the rest of the US equity market has largely drifted sideways. The US, just like the rest of the world, is still wrestling with inflation, especially services inflation, that is still well above pre-pandemic levels in most major economies. As a result, fixed income markets remain volatile. The resilient macro environment did, however, support the riskier segments of fixed income. While slowing in Australia and the US, both economies are still expanding. Europe's economic performance appears to be improving, and China's policymakers seem focused on supporting growth. We expect the slowing growth trend to continue as tight policy restrains activity, but the global economy is not going to be derailed. Policymakers will be cautious about lowering rates too far, too fast, but the rate-cutting cycle is underway. Yes, inflation remains above target levels in major developed markets, but in 2024, core inflation has drifted lower. Australia is unfortunately bucking this trend, making the RBA more sensitive to upside inflation risk. Now, rather than trying to second-guess every central bank move, investors should probably instead focus on the broad macroeconomic trends over the next 12 months. This time next year, we expect inflation and interest rates will be lower. That being the case, fixed income looks attractive, certainly more so than cash. Higher interest rates are good for bond investors, not only in terms of income, but there is also upside to capital values if interest rates fall. With credit spreads still near multi-decade lows, we remain cautious on lower quality, less liquid parts of the fixed income market. These are more economically sensitive and vulnerable to an unexpected recession. Now, investors are rightly concerned about equity valuations, especially for mega-cap US growth stocks. But we can't ignore the strong profits and cash flows these companies are generating. While elevated valuations and earnings growth forecasts make markets susceptible to a pullback, outside of major recessions, equities tend to perform well once rate cuts begin. Now, while early days yet, the anticipated broadening out of earnings contribution is unfolding. Growing profits for more companies in more sectors and in more countries point to greater opportunities across global equity markets going forward. So, what does this mean for portfolios? On the expectation that investors will focus on the rebound in profits in 2025, we increased the allocation to international equities back to the long-term weighting for our strategic asset allocation. The multi-asset portfolios, however, remain tactically underweight growth assets via Australian equities and property. Across defensive assets, we increased the tactical overweight to fixed income, funded from cash. With the rate-cutting cycle underway, the latter should outperform over the next 12 months. On behalf of the Elston team, thank you for your time. If you have any questions about this quarterly review, please talk to your advisor.